Most consumers are under the impression that they can't qualify for two mortgages. And a lot of them in the conventional space, that's correct, right? They can't qualify with their existing home and go buy another one. They may have their equity locked up. They don't have enough money for a down payment. And so not knowing about these solutions delays the opportunity for a transaction for their real estate agent sooner or ever, but it also adds a transaction to the loan officer earlier as well, because we do pay them on the bridge financing. But because we don't compete with the lender in what we call the takeout loan later on, when they pay us off, 95% of our bridge payoffs include a refinance of the new primary residence that they purchased. We don't do conventional financing. And so we always refer that deal back to the originating loan officer for another transaction on a refinance when the time comes for our bridge loan to be paid off.
Why would someone do this?
Sure, there's a handful of reasons why it makes sense. One to understand initially is this is private money. Private money is not conventional financing. So this is more expensive than just getting your traditional conventional mortgage. Because of that, we like to figure out creative ways to help the borrower recoup the cost of the bridge loan so it makes more sense for them. One of those ways is through professional staging and freshening up. When you're able to vacate your home, get out of there, declutter it, depersonalize it, freshen it up, whether it's painting or minor cosmetic renovations, and then actually professionally staging it, historically, you can get more money on the sales price than if you didn't. So that's one way to help offset the costs of the bridge. The second is by not moving twice, right? If you're going to sell your existing home first, you're going to probably have to move to temporary financing in the interim before you find your new home, close on it, and then move again. So rather than having moving costs twice, now you only have one, which helps offsets the bridge as well. So those are two of the biggest reasons. Another one is to eliminate or avoid the need to sell assets that may have penalties or tax consequences and keep them invested to avoid or eliminate those as well. Those are some of the main things on the surface on why a bridge loan makes more sense than some other types of offers that are out in the marketplace.
So, what makes your bridge product different than all the other bridge products out there?
The one thing is our ability to cross collateralize for higher loan amounts. And we're willing to take second lien position on the departure residence. A lot of bridge lenders want to pay off the existing first and remain in a first lien position. We're okay with second lien position on departure residence and first lien position on the new primary purchase.
How do you see loan officers, real estate agents using this product?
So there's two parts. The first part is any average to above average loan officer probably has a decent size to a large size database of pre-approved buyers. They're pre-approved. They may have a home to sell before they go buy a new one. There's your first, quiver to pull out and go contact all those people and educate them on this product, that it's available and why it may be a good idea. As far as real estate agents, they're struggling right now, just like loan officers are. They need something different to be able to offer prospects and potential customers that are out in the future because they need to sell their home first. And maybe it's not ready to put on the market yet, or maybe they're just not ready to do all the things they need to do to sell their home today. By a loan officer introducing this product and all the reasons why it makes sense, that real estate agent can go back to their database and educate them as well. Because at the end of the day, that's what this product is. It's an educational tool to help solve problems that buyers face in the marketplace today, and that they're counting on mortgage and real estate professionals to give them these solutions. And if they don't know they're available, they're not going to take advantage of them.
How does the cross collateralization work?
So, in a nutshell, we will take the value of their existing home, which we call the departure residence, because they will be selling that at some point in time, and we take 75% of the new purchase that they're looking at. So we simply just take 75% of both of those homes, minus any existing mortgages they have on their current home, and that leaves the amount that we're willing to finance for the new property. Many times there's a surplus, meaning that the amount that we have to use far exceeds the actual purchase of the new property. And what's important for that is we will actually lend more than 100% of the purchase price of the home. Well, why would somebody want that? Well, let's say they want to do some minor renovations or freshen up and professionally stage their existing home to maximize the sales price. We can give them additional funds if they need that, and it's available for that. Or let's say they want to do some minor improvements to the new home that they're buying before they move into it. If the LTV allows and funds are available, then we'll allow that as well. So it's a pretty neat and flexible product.
You had mentioned you're underwriting more towards the ability to exit. Can you just explain that a little bit more?
Yeah, good question. So our term is 11 months. They're interest only payments, no prepayment penalty, which again is different from some of the other bridge lenders. They want to carry that loan on their books for a certain amount of time before you can pay it off, or else there's a prepayment penalty. So when I say we underwrite with the ability to exit, it's okay. Within that 11-month time frame, how is this consumer going to pay off our bridge loan in full? And although our terms are 11 months, on average, our loans pay off in 3 to 4 months. 9 out of 10 times, the payoff happens when they sell their departure residence. Many times, however, 95% of the time, after selling the departure residence, there's not enough money from the sale of the departure residence to fully pay off our bridge loan. So the consumer then has to go and apply for conventional financing, or in some cases with self-employed borrowers and things like that, some non-QM permanent financing. And so as long as the exit strategy makes sense, then we'll go ahead and underwrite based upon that. Some people may be coming into money down the road, whether it be from inheritance, and we verified that. That's another reason. If there's a divorce, that's another reason why people look at some of these bridge financing loans as well.
How quickly does something like this close?
We do follow TRID, and so we do have a timeline to close. But typically, 14 days, we can close these loans. Normally, we close in about 21. We've closed in as little as 5 days in the past.
Do you need title appraisal, all of those things?
Typically, we don't need an appraisal. We do AVMs internally or outsourced BPOs, but we do need title.
What's the kind of the craziest scenario you've seen since you've been there?
The craziest scenario was a self-employed borrower under contract for a $4.5 million home, put $150,000 down, and was pre-approved earlier in the year before his tax returns were filed and are due. But tax season and extension season came and went. He didn't file his returns. And so they said, sorry, you don't qualify anymore because we now need your 2022 returns. And so he was about to lose $150,000 in earnest money and the property. He was referred to us. We knew that he was going to file his tax returns in the first quarter of 2023. And based upon that and the P&L and how his income was trending, we lent him, a little over $3 million and got him the home. And then April of this past year, he went ahead and paid us off and got approved with a different jumbo lender for a 30-year term loan. So that was probably the craziest one.
As far as the properties, I know one of them needs to be a primary residence. Can it be investment properties? What's the cross-collateral piece look like?
Yeah, that's a great question. So it's very important. Every single purchase, because there has to be a purchase component to these bridge loans, every single purchase must be for a primary residence. We do have some exceptions for second homes that we do on occasion, but for the most part, it's got to be a primary residence, and we will never do for an investment property. However, our parent company, Pacific Private Money, does biz purpose loans all the time, and that's what they specialize in, and they will do bridge loans on investment properties. So, we're kind of the catch-all. The relationship comes through a rival. If we can't do it, we'll make sure that either our sister, Pacific Mortgage Capital, which is a non-QM lender, can't do it, or maybe Pacific Private Money, our parent, can do it. And because we're in the alternative lending space, we have outlets to a lot of different sources of capital, and they each have different appetites of what they're willing to purchase. So we have a lot of outlets. Now, the cross property, the departure residence, we will cross with their existing primary residence. We will cross with an existing second home. We will cross with an existing investment property. We will even cross with somebody else's property that wants to loan equity to this borrower so they can get the money to purchase their new property, which needs to be a primary residence. So it's, like I said, it's flexible, but it's pretty unique in that aspect.
Did I get that right? So mom and dad own their house free and clear. Kids want to buy a property today in a hurry. You could take the new purchase property plus mom and dad's free and clear. Kids could use this property to purchase the new home.
Yes, asterisk. If the kids have an existing primary residence, that must be sold. So any existing primary residence has to be sold within that 11-month time frame as part of the exit strategy. Correct. Now, if there is no departure residence, let's say they don't own a home currently and they want to purchase a new one and they don't really qualify today, but for whatever reason, within 11 months they will, that's something that we would consider. But again, 75% loan to value, they would need to have 25% down payment. That down payment could come in the form of a gift. But again, we're going to be underwriting to the exit a little bit more stringently than if they already owned a home, because we've never stuck anybody with one of our loans. And we pride ourselves on that. We want to make sure within 11 months, our borrowers can pay off and get out of our bridge.
I see this as a product for financial planners. People are coming to them all the time, asking them, hey, how do I go out and buy this house? And sometimes selling a whole bunch of stock right now at this time of the year or whatever is a terrible idea. This puts them into a different product until they can sell their house. This just opens up a whole other set of options. They now can do everything with a plan than very reactionary.
Absolutely. And because these loans are more expensive, there's this sticker shock first that a lot of homeowners have. But once it settles in and they learn and they become educated, it's kind of like if you're in a competitive market, right? And you see this beautiful home you like and they're asking $750,000 for it and it's very, very competitive. Would you offer 760, 780 or 785 to get the property, knowing it's going to appreciate quickly, knowing that you're not really paying over for very long? It's more of an investment. That's kind of how they need to look at these bridge loans as well. It's more as an investment to solve the problem and get into a home sooner and take advantage of the equity that's going to appreciate and build over time as well.